India, prior to 2017, operated under a profound contradiction. It was a single political entity, but economically functioned as 30 disjointed walled markets. This graphic illustrates the reality of that era. A single product moving through the supply chain was targeted by a dense web of overlapping central and state levies, excise duties, service taxes, state sales taxes, and local entry taxes like octroi. Octroi is a local tax collected on various articles brought into a district for consumption. Looking at the right side of this diagram, we see the immediate financial consequence: cascading costs. Because different jurisdictions levied these taxes without a shared credit system, businesses routinely paid taxes on values that had already been taxed by a previous authority. Moving down the graphic, we see these financial layers created physical bottlenecks. Central sales tax and local entry taxes required mandatory border checkposts between states, forcing transport trucks to sit in hours of administrative queues just to cross a domestic line. Finally, at the bottom, we see how this distorted corporate strategy. Companies designed their physical supply chains and placed warehouses specifically to avoid crossing certain borders and paying extra taxes, completely ignoring actual delivery speed and logistical efficiency. A manufacturer could not simply scale up one massive central facility to serve the whole country. They had to build redundant, inefficient mini-networks in every single state they wanted to sell in. The pre-GST tax regime imposed a structural penalty on supply chain efficiency, impacting national growth far more severely than a simple accounting burden. The first major attempt to clear this internal friction came in the early 2000s with the introduction of state value-added tax, or VAT. This diagram outlines the mechanics of that reform. That shifted state-level goods taxation to a multi-point model. Instead of taxing the total price of an item repeatedly, the state only taxed the incremental value added at each step of production. But panning across to the broken section of the bridge reveals the structural gap in this architecture. That only applied within individual state borders, and it strictly separated the taxation of physical goods from services. For cross-border trade, the central sales tax remained firmly in place. The CST was an origin-based tax on interstate goods, requiring heavy paperwork and generating costs that could not be legally offset. As noted at the bottom of the graphic, individual states retained immense variation in their local rates. A company selling industrial machinery might face 5 different tax rates across 5 neighboring states, making standardized national pricing mathematically impossible. State VAT repaired the math within individual state borders, but it left the gaps between them wide open. India still lacked a cohesive national market. In July 2017, the Indian Parliament passed the 101st Amendment. This legal maneuver allowed both the central government and the individual states to concurrently tax the exact same supply base for the first time. This legislation collapsed 17 taxes and 13 cesses into a unified framework: CGST, SGST, and IGST. To secure agreement, the government established the GST Council as an economic parliament. The voting math is specific. The center holds exactly 1/3 of the weight, while the states collectively hold the remaining 2/3. Passing any new policy or rate change requires a strict 75% supermajority. This mathematical architecture mandates cooperative federalism. The center cannot push a rule without heavy state support, and the states cannot bypass the center, ensuring national economic policy remains stable. The mechanical engine driving this unified system is the input tax credit, or ITC. This diagram maps the credit flow. A manufacturer adds 1,000 rupees of value, generating a 100 rupee output tax. When sold to a wholesaler, that paid tax passes along as a digital credit. The wholesaler adds 200 rupees of value, creating a gross tax of 120 rupees. Using the inherited credit offsets that liability, dropping their net payment to 20 rupees, taxing only their specific value addition and eliminating the tax-on-tax effect. Because this self-policing credit chain is entirely digital and applies seamlessly across state lines, the need to physically stop trucks to collect local border taxes vanished. Digital e-way bills replaced paper documents and checkpoint queues, allowing freight to blast across domestic borders without touching the brakes. This metric highlights the result. Interstate transport time fell by over 33%. Corporations responded by replacing tax-driven state warehouses with massive, efficient hub-and-spoke logistics networks. This formalization drove massive compliance, yielding 22.08 lakh crore in gross tax collection for the 2024-2025 fiscal year. A lakh crore equals 1 trillion. By connecting the tax credit chain, GST 1.0 successfully unified the Indian market and achieved a surge in physical distribution efficiency that was previously impossible. However, this physical speed masked a growing administrative burden. The friction had simply moved from the highway checkpost to the corporate back office. This isolates 4 critical gears grinding the system down. Early manual ITC allowed bad actors to exploit fake invoices. Compliant businesses faced severe working capital locks from delayed refunds, massive compliance fatigue from changing rules, and a highly bottlenecked dispute resolution process. The architecture was logically sound, but its reliance on manual data entry and human reconciliation made it highly vulnerable to error, delay, and abuse. The solution is the current phase of reform, effective through 2025 and 2026. Looking at the third pillar of this blueprint, we see this is not new legislation, but the deployment of AI and system-bound rights to strictly enforce the original design. Input tax credit is no longer something a company manually calculates and claims on a form. It is now a rigid, system-bound right controlled entirely by the tax portal. Step 1 mandates B2B transactions instantly generate an invoice reference number, or IRN. Step 2 enforces strict sequential filing. Skipping a month blocks the next cycle. Step 3 introduces the hard lock. Any supplier data mismatch automatically freezes the buyer's input tax credit. Manual adjustments and tax planning have been engineered out of the ecosystem, replaced entirely by cold automated data matching. This algorithmic enforcement completely alters the reality for corporate procurement teams and supply chain managers. The threat is clear. Tax credits depend on vendor compliance. Failure freezes credits, severely draining working capital. Mitigation requires vendor scoring and integrating ERP, enterprise resource planning, with GSTN, the Goods and Services Tax Network, to track supplier behavior. This transition roadmap illustrates how companies must adapt. They move from conducting foundational compliance audits in the first 3 months to deploying automated reconciliation controls, and finally achieving live AI-driven compliance dashboards by the end of year 1. This final graphic points to the new reality. Operating in the Indian market no longer hinges on navigating border bureaucracy. Success now requires absolute data discipline and strict vendor governance to achieve frictionless, automated scale.